Welcome to the Lighthouse Financial Advisors Money Over 50 podcast with Dallas Davison and Michael Hogue. This information is general in nature and does not take into account your objectives, financial situation or needs. Therefore, you should consider whether the information is appropriate for you and your personal circumstances. If you require personal advice, please contact Lighthouse Financial Advisors. Here are your hosts, Dallas Davison and Michael Hogue.
Welcome to Money Over 50. Today, Michael, your topic, which is taxes in retirement.
Taxes in retirement. The Mecca number being zero.
Zero tax.
In fact, you can actually have a situation we'll get to where you're positively taxed in retirement.
Yeah.
Which seems
very
true. Strange, too good to be true. But
so what we're talking about here obviously is, and a lot of our podcasts are geared towards, obviously, a lot of people come to see us for the first time at 55 or at 50, and they're sort of about 10 years out from retirement. And there's obviously a lot you can do in terms of tax planning leading up to retirement while you're still working. So what we're talking about here is on the other end of that, because a big part of your tax planning over your last 10 years of your working life is not just around how to save income tax while you are working. It's to get yourself set up so that in retirement, as you said, the holy grail is that one of the big things that we look to achieve for all of our clients is to get to the point in retirement where you pay not another $1 of tax ever again. And you're going to go through a bit of a case study and talk a bit about how that's possible and what the options are.
So we're right now at the snapshot point of time at retirement.
Yep.
For a couple. And looking back, if you had been set up correctly, you would find that most of your assets that you're going to draw an income from in retirement would be inside your superannuation funds at that point in time. And we're going to assume, just for the purposes of the calculation today, a $2 million total balance across the couple. And it can be less than that. Yeah. It can be more than that. We'll talk about a few different things. Yeah. What makes a difference on $2 million? Obviously, with our tax system, the more money that you have, the more you're generally taxed through
a progressive tax system. Which doesn't mean that it's really good or really forward thinking. It just means that as your income gets higher, the rate of tax that you pay on that top marginal piece of your income gets higher. So,
yes.
So just to explain a bit about the terminology that we use, as you're saying there, we're talking about a retirement savings balance of $2 million, and we always we sort of use super and retirement savings interchangeably a bit in this podcast. And the reason for that mostly is that, as you'll sort of explain, for most people, superannuation and those environments are the best place to have your retirement savings. And you're going to explain a bit about why. But when we're saying retirement savings, we just mean all of the money that you have that you are drawing an income from in retirement.
Yes, and so if you had been set up correctly, our belief, and you'll see why that's our belief, is that you'd be sitting here right now saying, I'm just retired, or I'm about to retire, and we have the vast preponderance of our money inside of our superannuation funds. And in this case, we're going to use the example of $2 million for a couple. It could be $1 million for a single person. It could be any variation of that. Ideally, those people would have $1 million each in each of their superannuation funds.
And why is that, Michael?
Well, there's a thing called a pension transfer balance cap of $1.6 million per person. So forget the boring terminology here.
Account-based pension.
Just think of this as the maximum amount of money that you can have per person where you pay 0% tax.
Yeah.
So $1.6 million each.
Think of a pension as a tax-free company, or a tax-free trust.
Yes.
You own your retirement savings in, no tax to pay on any earnings or any income drawn from that.
So in this example, a couple has $2 million each in their superannuation funds. It could be a variation of that. Yeah. Three main choices at retirement. Yeah. The first one is to cash out. So they can cash all that money out of superannuation. Yeah. What they would then do is they would then have to really invest it in their own names, let's say.
Yeah. So when you're saying this about, that touches on a point where at retirement, you have this choice both leading up to retirement. You have the choice of where do you build up your retirement savings, as in do you put your spare cash flow into super every year, or do you just invest this in your own name? And so this is where we've said, this is assuming that someone has already done the work of getting that money into super and they've cashed it out. For some people, as you said, if they haven't structured this correctly, they don't have that choice, because they might have $2 million that they've saved, but that might they might have just built that up in an investment in one of their names.
So either way, yeah. So either the money has gone into super first and they're cashing it out in this example, or they haven't got it into super at all and they have the $2 million in their own names or names, name or names. So effectively, then they get to choose to invest that. Sorry, I'll back up. If they're aged over 60, they're able to cash that entire $2 million out tax-free.
Yep.
So there's no tax on cashing that out. However, of superannuation, so they've hit age 60, they've met a preservation condition of release. Yep. They've decided we're retiring. What we'll do, we'll cash that $2 million out, and we'll go along and we'll invest it in our own names, or we'll buy, any number of things that are going to derive an income for them. Now, if they get a 5% taxable income, and we won't go into what they're invested into today, but I mean a 5% taxable income, if they're invested across a broad group of companies, then they would find that there's about a 5% taxable income every year. If they're invested in commercial property, they'd probably find about the same.
Similar,
So what we're talking about with $2 million here is that they would earn 5% taxable income, $100,000 of taxable income. Now, what happens is that's taxed as income tax in their own names then. So that $100,000 is if they went to work and earned $100,000 of income. If that's all in one person's name, they pay $25,000 in tax through the tax brackets, progressive tax brackets.
That's a good example of what can happen here is as you say, if they cash this out of super, then they have the choice at that point in time of do they invest it in each name or in joint names or whose name. But what you see a lot of, if there's no planning on the way through, it just builds up in one person's name, and so this is sort of the worst. I mean, there's a lot of worse situations to be in than to have $2 million in retirement
that's right.
in one person's name. But in terms of your tax planning, that's the worst case situation, because you've got all of the income flowing through to one person, and as you said, as that income gets higher, they're paying a higher and higher percentage of income tax.
And I guess they're volunteering $25,000 of unnecessary taxation here in this scenario, because we'll show you where that could be much lower than that.
I think that's why taxes in retirement to me are a really interesting one, because it's such a clear-cut example of. So in this case, in these case studies you're going to talk about here, you've got $100,000 worth of income. Every dollar that you give to the ATO is a dollar that you don't get to spend. So if you've got $100,000 worth of income and you've got a $25,000 tax bill, that's a huge overseas trip every year. That's a lot of money.
And look, we have an amazing system in Australia here. So we're one of the highest taxed developed economies in the world while you're working. Now, in retirement, we're actually one of the most generously taxed. So I guess the way to think about this is that if there's any part of you that has any sort of moral inclination that why shouldn't I be paying the tax in retirement, what you could think of is that I've paid overs. Now, if you've accumulated $2 million, you've probably paid overs a lot during your working life. You've paid a higher rate of tax than most people around the world, and if you can eliminate that voluntary tax in retirement, you could probably look at it from that point of view.
The way that I think of it, I guess, from a moral or ethical point of view, well, when it comes to minimising income tax, I don't have an issue with it at all. But if you do think that, if you think of it from the perspective of the government isn't giving you tax advantages in retirement out of the goodness of its heart. Really.
No.
What it's basically doing is any government around the world, and the Australian government's no different, wants you to be a self-funded retiree. What they don't want you to do is to to spend your money in retirement and then be on Centrelink, which is something that then the government has to foot the bill. So what they're effectively allowing you to do with these different structures is there's nothing dodgy or illegal about it. They're basically incentivising you to save for your own retirement. And so in the same way that we talk about this, while you're still working, the reason you can salary sacrifice to super and do those kinds of things is because our government, our tax system wants to incentivise you to save for your own retirement. So when you get to this point in time, there's nothing about this that it's not like you've set up some offshore company. We don't think this is all part of the Australian tax system of saying we want you to be set up in the most effective way.
It's a good time to raise that point because this is all perfectly legal. This is completely legal, operating within the guidelines. So option one, you cash that out. You have to invest that in your own name or names. Then, $2 million earns about $100,000 of taxable income. You pay about $25,000 in income tax on that. Option two, you could leave the money in superannuation at that point in time. And if you wanted to draw down from it, you could just draw down. Again, there's nothing to say you have to draw down the whole lot. You can draw down that $100,000 a year that you're earning in this example. In option two, you've just left that money in superannuation. You've invested it identically to the first option. It therefore earns you 5% taxable income. Now, inside superannuation, the flat rate of tax is 15%. So you lose $15,000 in tax off that $100,000 of earnings. You're left with $85,000.
So what you're saying is you have the same earnings of $100,000. You pay a 15% earnings tax rate. You could take that $85,000 out tax free every year. So in that same example, slightly better than the first option, but you're still losing $15,000 a year in tax.
That's right.
So I feel like most of our podcasts revolve around a rule of three. There's sort of three different ways of three things, and never get the third example, which I'm sure is going to be the best one.
So the third example, you can convert your existing superannuation funds into what's known as a super income stream or a superannuation income stream. Look, this is so confusing, and without digressing too much, this is also known as an allocated pension, an account-based pension, a pension. I call it a superannuation income stream because I feel that
it's indicator of what
it actually is. Your money stays in the superannuation environment. So this is a differently taxed, but still inside superannuation environment. And the taxation rate, which I said was 15% before for superannuation, actually cuts down to 0% for a superannuation income stream. Now, going back to that $1.6 million transfer balance cap that we started off this podcast with, what that is it says for each individual, they can have no more than $1.6 million in fact, it's, to really be accurate, they can have more than that. They just can't start a superannuation income stream,
which is another whole thing around planning of how to maximise the amount that you start with and then let that grow.
I mean, in this example, we don't want to digress too far. You've got $1 million each in each member of the couple.
And this is where you're saying that you actually don't want that entire $2 million in just one person's name inside superannuation, because they won't be able to get the full $2 million into an income.
That's right. So they wouldn't be able to in that case. They'd be capped at $1.6 million. I mean, there's ways around that. We won't go into that. It's just going to digress too much. So $1 million each. What they do is that they both open a superannuation income stream, or an allocated pension, or an account-based pension. They're all the same thing. Effectively, then, what happens is that their superannuation has to pay them an income each year. So you have to take a percentage of that. And at 60, let's assume they're age 60, that percentage is 4%. So on the 1st of July every year, they look at the account balance. In a simple equation, they've got $1 million each. They would have to take 4%, $40,000 each as income. They can take more than that, so the sky is the limit. And when I say the sky is the limit, you can take as much. It's like a bank account. You can take as much as you want out of a bank account. It'll run out if you take too much. It's a minimum income. It's a minimum income. It's not a maximum.
And that's, I guess, there's two parts to that. The tax there is that there's there's no tax on the earnings that money has made, and then there's also no tax on the income that you pull out.
Well, here's the you have to take an income. That's one of the requirements. Whereas if you leave it in superannuation, you don't have to take an income. Look, you want to take an income anyway. You were just retired.
Yeah.
As a trade-off for taking that income, the government will allow the earnings or the taxable earnings. In this case, it's still the same 5%. You use the same assets in all of these three examples. So it's $100,000 between the two of them of taxable income. 0% tax on that. So if we go back, it was 15% tax on if you left the money in superannuation, and it was 25% tax if you cashed it out and invested in your own name. 0% tax on that money in the superannuation income stream, and you can draw that money as a tax-free income as well. So effectively, think of no tax to pay whatsoever.
And that's I guess the way that I think of this is that we, throughout that last 10 years of your working life, there's all sorts of tax advantages to why you might put money into super versus invest in your own name. But separate to all that, even just this case, there is three different people, one who've got all that money invested in one person's name. That if you think about the different lifestyles, I always think when we talk about percentages of tax and that kind of thing, if you break it down for one person's living a lifestyle where they're getting to spend $75,000 a year, the next person's getting to spend $85,000 a year, and the third person's getting to spend $100,000 a year. And they've all got the same amount invested, they're invested in the same assets, they're not taking any extra risk, they haven't done any extra work leading up to there.
That's the interesting part, isn't it? So they're taking the same amount of risk, and we haven't even gone into what they're investing into, but they're all taking the same amount of risk because they're invested in the same things. It's just that they're invested in vastly different tax structures. And there's a couple of misconceptions that people have, I guess, asked me over the years with regards to a superannuation income stream. One of those misconceptions is your money locked away, and it's not. So there's no. This is different. There's a thing called an annuity that's quite a bit different to this. So your superannuation income stream has an underlying balance, just like your superannuation fund does.
Which is good and bad, and this is kind of what we talk about. Where you then are in control of that, both from the perspective of you're in control of how much of that do you spend every year without running the risk of running out of money. But as you say, you are in control. If you need to draw more money out, then you can at any point in time.
Yes, that's right. So it has an underlying balance. That balance will fluctuate depending on that balance does not disappear on your death. The balance it gets passed on to your loved ones in the event of your death. It doesn't disappear at that point in time. There's no lock-in period. So you can unwind this at any point in time. You can cash that superannuation income stream out in part or in full, tax-free.
And it's a really interesting one, that one, because I find that that's something that gives people comfort, even though you're then left with the same thing of, okay, so if you've got $2 million in your account-based pension or in your super income stream, I think we know that we can get that money. So if I needed that $2 million, I can pull it out I can pull it out. But then you're left with the problem of, well, then I've got to invest that in something in my own name.
That's right. Look, it's a really nice one to have just to know that you can cash it out at any point in time. So if you need that money, there's no lock-in period. There's no lock. I mean, again, without digressing too much, what you invest into inside might have a lock-in period if you invested in illiquid property or anything like that. But if you diversify it into liquid assets, you can cash it at any point in time. You can take it out. You can do with it what you want. It's just, why would you do that when you've got 0% tax?
Well, the other part of it, if you, because I guess in some situations you might be invested in retirement in a way that, so for example, you've got your $2 million, but at some stage in the early years of retirement, you're going to travel around, and then when you come back, you're going to buy a house somewhere. So you might have $500,000 of that you've got in your mind that you go, that's what I'm going to do with that, is buy a house when I get back to Australia or back to Townsville or back to wherever. In that case, you're actually still much better off having that in an income stream. And the reason for that is that where we're talking about your taxable income, if you've got that invested in your own name, that is only the earnings on that. If you were to sell down a significant amount of that, you would also be hit with an extra capital
gains tax.
So, whereas owning that through an income stream, if you get, whatever you're invested into, if it goes up in value over the next 3 years, and then you go, okay, I'm going to take $500,000 out of there and sell and take that and buy a house, there's no tax to pay on the sale of that asset within there. There's no capital gains to pay.
Yep.
There's no tax to pay on the income you've drawn. Whereas the money invested in your own name, you could get your $100,000 every year, and you're going to have to pay $25,000 income tax. But if you wanted to sell $500,000 worth of those assets, you're likely going to get hit with another big bill, which is going to be your capital gains tax on that.
That's right. It's a good point to make. So again, 0% capital gains tax, which is another hidden benefit in there.
Yeah.
But the other thing that's really good as well, so in this example, this couple with $2 million, $1 million each in that superannuation income stream, $100,000 of earnings between them. Let's just assume for a second they both take $50,000 each as income. So they take the $100,000 that the fund's made and spend it as income. No tax on that as they take it. No tax on it as it's earned inside their super income stream. No tax as they each take the $50,000. Now, on their tax return, this is the other hidden gem. That $50,000 that they've taken as tax-free income, not only is it tax-free, it doesn't show up anywhere. So where that's really useful, so there's people that military pensions spring to mind here. So there's some people that have done their 20 years in the military a long time ago, and got a $30,000 amount that's coming in from the DFRDB. While they're working, that $30,000 gets tacked onto their earnings, and they pay a really high rate of tax. Once they've turned 60, if they've set up this way, if they've retired, that's their only income at that point in time. So there's only $30,000 of income. The $30,000 isn't tacked onto the $50,000 that they've drawn from their super income stream. It's the only source.
And this exactly the same thing applies if you're working part time in retirement. Where, if you're doing $30,000 worth of work, if you've already got $50,000 worth of taxable income from your retirement savings, that $30,000 that you earn from work, you're paying 34.5 cents in the dollar on that. So
that's right.
You go to work, you earn $30,000, you only get to spend $20,000 of that. Versus if you've structured this way, the $30,000, you probably pay, I'd say, only about a couple of $1,000 in tax.
You get again, risk of digressing. You actually turn 60, you then get a 10% tax offset on that $30,000. So it's a tax credit of $3,000 towards the $30,000 towards the income tax that you owe on that $30,000. So effectively, it wipes it out.
And there's a heap of different. The way I always think about it with this sort of planning, where you go, even if you assume that you weren't going to earn any other income in retirement, you were just going to live on your retirement savings. If it doesn't cost you anything to give yourself that option, why not do it? Like, if you went, I probably won't work part time, but if I do go to work part time, I don't want to be going to work part time and only getting to keep 2/3 of the income. I want to go to work and keep all of it.
That's right.
My attitude would be leave yourself as many options as possible by having that through the income stream.
Absolutely. Now the
death taxes, is that what you're going to talk
about? No, I was going to talk about franking credits before then. So this. We've always struggled to actually.
I just read on your notes you've just got death taxes. Let's go. It's pretty full.
Well, we need to talk about that because actually we do because that is taxes in retirement. So franking credits. So let's assume in this couple's example that of that $2 million that they have together, $1 million each, that combined together they invest. About, let's say they invest $1 million of that, half of that money across the top companies in Australia. And this is only available for Australian companies. Effectively, what would happen is that on that $1 million of money that they've spread across, let's assume our top blue chip companies in Australia, if we're working on a 4% dividend rate, they would receive about $40,000 of dividends from those companies. Now, those companies have had to earn $57,000 of income profit to pay $40,000 of dividend. The reason is, if you look at the company level, so this is the fragment of shares that they own in each one of those companies. Those companies have actually earned $57,000 of profit attributable to that couple. Directly attributable to that couple.
As a shareholder.
Those companies pay a collective amount of $17,000 in a bit of change in tax to the ATO. That money sits over there at the ATO. When that couple does when the super income stream does its tax return, it says, "Thank you very much, ATO. I'll be having that $17,000," and that $17,000 comes into their fund as this is not a tax offset. This is physical dollars hit the account.
And this was the big thing in the last election, was about refundable franking credits, and this is what the Labor government was proposing, which was politically it was never going to play well. Where he's saying to someone, "Hey, you've worked hard all your life. You've got to retirement. You've structured things in a way where you have you've invested in our economy, in blue chip Australian companies. They've paid this tax. You're a poor old retired battler. You get your dividends, and you were getting the extra franking credits attached to that." What they were saying is, no, you wouldn't get them if it was a refund. You would only get that as an offset.
So it's a hard one to conceptualise, but just think of this from the point of view: your tax rate is 0%.
And the company has paid tax.
So the company, the percentage of those companies that you own, which although it's small and it's very hard to view and conceptualise, you own a percentage of those companies. Those companies have paid $17,000 in tax on your behalf. Because you're an owner of those companies. So because your tax rate is 0%, you actually get that money back as a.
Well, it's no different to, I guess, if you think about it, when you're working, if you get taxes withheld on your behalf by your employer, goes to the ATO, and at the end of the year, you do a calculation to say, how much should you have paid for the year based on your taxable income? If we've withheld more tax than what we were entitled to, they'll actually refund you the amount that you didn't need to pay.
That's right.
That's the same sort of thing here. But it was pretty tough one for Labor to get across the line here, because it's number one, very complicated, and number two, the people that were most going to be impacted were the people retiring with $1 million.
I always said it was theft. What I said was, no, you can't do it that way.
No.
If you're going to do it that way, you've got to say that there's an earnings tax on a super income stream of 5%, for example. So any income that you earn is
treated the same way.
Is taxed at 5%. You then get to use your franking credits to offset that and give you the difference in the rebate. But we won't go. We won't go through that.
We have done a podcast about franking credits, haven't we?
Well, I think we might have. I think it's called franking credit. So,
before we get into great detail about this again, if you want to,
it might be called franking credit, not just a great racehorse name.
Could easily be.
So wrapping up, I guess in this scenario, look, there's very. I should say that in the first and second example, so either the cash out and invest that money, you would still be entitled to those franking credits. In that case, instead of paying $25,000 of income tax, you'd get a $17,000 franking credit. You would pay $8,000 in tax. In the second example, where you have you keep the money in superannuation accumulation phase, 15% tax. You would owe $15,000 in tax. You would get a franking credit of $17,000. You would therefore, it would wipe out your tax bill. You would get a $2,000 refund. Whereas in the third example, you pay 0% tax, no tax, and you get $17,000 as a rebate, and that money has not appeared out of thin air. You have paid that tax
via your company,
via the tiny little slither of companies that these people own across. I say that it's a slither. It is when they, assuming they've spread that $1 million across the top 100 or the top 200 companies in Australia, they own a slither of each one of those companies. So, but that slither has been enough to have $17,000 tax deducted at the company level from those company profits.
Now, before we wrap up, death taxes.
So here's the downside. Here's the downside to this. Yeah. So again, you've got a member of it. Well, you've got a couple in this case. Mm-hmm. So you can opt to leave your superannuation income stream to each other as what's known reversionary beneficiary. Yeah. And what that means, your spouse is considered a tax-dependent beneficiary. So there's a special type of class of tax-dependent beneficiary. There are other classes. We won't go into those now because by the time natural death occurs, basically, generally speaking, your only other type of tax-dependent beneficiary is each other. Yeah. So on the death of the first person, there's no problem. So let's assume that they've taken all of the return every year. They've still got that $1 million. They're both 85 now. Yeah. Let's kill the husband first. He deserves it. So get rid of him. The husband dies. Yeah. He leaves his $1 million as reversionary beneficiary to his wife.
Yeah. And that's tax-free to her.
So that's tax-free to her. Now, here's the important thing. She isn't compelled to cash that money out. Yeah. She does have to fit that money under her $1.6 million transfer balance cap.
And there's a heap of different ways to skin that. Again, going back to the poor cats, but there's a heap of different ways to skin that cat, and that is a bit of a technical one as to how you... Yeah. Which one of those pension accounts you'd then retain, which one you'd cash down, those sorts of things. But effectively.
And look, for the vast majority of people, the rules will probably have changed by then anyway. We're assuming normal, healthy retirements. Yeah. Someone retiring now, it's 85 probably on average before the death of the first person. Yeah. That person dies, they leave their money reversionary beneficiary to their spouse. Now, what's important there is that subject to those transfer balance caps, the spouse can actually leave that money in pension phase and just draw an income from it. Yeah. And
so they end up in the same position, no extra tax to pay, no tax to pay on that money going across to the spouse.
That's right. So, the issue comes on the death of the second person and assuming that they don't have any tax-dependent beneficiaries. Yeah. Now, by that stage, their children, of course, naturally in their 50s or even 60s. Yep. So, generally speaking, they're leaving money to non-tax-dependent beneficiaries. So, without going into all the detail of that, the tax that you pay on that is 15% plus Medicare levy. I forget what the Medicare levy is right now. It's slipped my mind. Is it 2%? 2%, yeah. So it's 17% tax. So on that $1 million of the husbands and the wives in that case, if they were to pass that money on to their children, their adult children who are standing on their own 2 feet for decades by that stage, there'd be a 17% tax levied, maximum 17% tax levied on
and we won't go into the details as to that's only relevant in some cases, not others, but that's kind of the worst case situation. And so what you want to also do as part of this planning is you want to minimise the amount that is going to get taken out as an inheritance tax. And so we've already done a podcast talking about this in great detail, which is number 39, called How to Avoid a 17% inheritance tax. So there are different strategies leading up to retirement and in the early years of your retirement for how to effectively change the money that you've got in your pension account so that it becomes tax free going to your non-dependent beneficiaries. That's one of those ones people get a headache just thinking about how to do this. So if you're interested in that, listen to episode 39, and that goes into a fair bit more detail. But it is, as you say, that's the thing to bear in mind for people is that another one when you think about taxes in retirement, there's the earnings tax on your retirement savings, there's the tax on any income drawn out of there, and then also potentially tax on your death. Yes. So you really want to try and minimise all of those three on the way through.
That's right. Is that about it?
That's probably about it.
I'm disappointed because I love talking about this stuff.
No, well,
I love talking about tax strategy.
Even any one of these things, we could go into great detail about franking credits or death taxes or earnings, all the rest of it. But I think this is a good overview and probably a good little wrap up of why this is so important.
Thanks for listening.
Thank you for listening to the Money Over 50 podcast with Lighthouse Financial Advisors. We look forward to catching up again soon.